you a Gen Z balanced investor and you want to cut your fees in half for the next 20 years? If you stay to the end of this video, we'll show you exactly how you can cut your money management fees in half. You need a benchmark so you can track how you're doing to the rest of the world. The best benchmark is the Vanguard Balanced Index, VBAIX. You can look this up. It's got a long track record. It's got a lifetime rate of return in the 7s. For a Gen Z balanced investor, that is a good, fair expectation of returns. Why in the world would you pay 1% to manage the fixed income portion of your balanced investment over the next 20 years from, say, 50 to age 70, when you can simply lock up a great return on the fixed portion and not pay any fees at all? So here's what you need to know to be able to build a low-cost, balanced portfolio that's appropriate for a midlifer, a Gen Z from 50s to the 70s. First and foremost, a balanced portfolio is like 50% in equities and 50% in fixed income. Equities need a lot of management, but in many portfolio management programs, you'll see they charge 1% on the entire portfolio. So let's do an example. If you happen to have $1 million in all your retirement funds, and you're paying 1% on $1 million, that's $10,000 per year. And in there means you're paying 1% on half of that money that's in fixed income, which is usually treasuries, fixed income annuities, something that's guaranteed. And in many cases, you can get those investments with zero fee. Here are some suggestions for you. Certainly, if you're a balanced investor and half your portfolio needs to be fixed and safe, there's absolutely nothing wrong with putting that in like a 30-year treasury. The numbers on a 30-year treasury are about 4.7%. Also, there's nothing wrong with putting those investments into a fixed, guaranteed, insured GIC, guaranteed investment contract, or an annuity contract, something that's got no moving parts, a guaranteed interest rate, and zero annual fees. The third option, of course, is if you want a little bit more excitement in your portfolio. Eli Lilly, the huge drug company, just came out with a 40-year bond that's about 80 bips over the treasury. So it would be about 5.5%. Now, slightly more risk there because you're buying a bond in a major corporation. I wouldn't worry too much. If you look up the financial status of Eli Lilly, I don't think they're going anywhere. But 40 years is a long time. So you might have a lot more confidence in some big blue chip insurance company that has great financial ratings. So now let's summarize what we're talking about. You're a balanced investor. You want to mimic the Vanguard Balanced Index. So you've got half your money in equities and you've got half your money in fixed income. Instead of paying $10,000 a year from, say, age 50 to age 70, that's 20 years. Instead of paying $200,000 in fees, which, by the way, is not outrageous, just for some of you, you can save some money by allocating that 50% to fixed income in some of the things that we've talked about and pay no fees and cut your fees lifetime by 50%. That means you can preserve $100,000 more of your balanced investing portfolio without taking on any more risk, without actually giving up equity management that I think is very important, which good investment advisors, registered investment advisors, financial advisors get paid fairly to manage 1% of an actively traded equity portfolio. But I don't think it makes much sense to pay 1% on a fixed income investment that's going to sit there and just look wonderful, like ballast in your portfolio between age 50 and age 70. So pull out your statement. If you have questions about this, by all means, park them down below. We'll answer as many as we can. subscribe to the channel, follow us on YouTube and our podcast, right? Give us a comment about this video and any other video that you think is helpful for you. And by all means, see if you can get a hold of our books, either Smart Financial Grandparenting, Smart Financial Longevity, and Smart Financial Wealth Building, right, on Amazon. You can download them. If you have a subscription, you can get them for free. You can get the ebook. Reach out to us, and we'll be happy, if you're a subscriber to our channel, to get you a free copy of one of our books on smart financial management. Reducing your fees on your portfolio over your lifetime is just part of the art of being smart.